Welcome back to The Explainer. Today, we are diving into a complete financial autopsy on Centuri Holdings. We're going to take all their raw data, tear it apart, and really uncover the actual story behind the ticker symbol CTRI. This is a genuinely fascinating company with some absolutely wild, contradictory numbers, and we're going to break the whole thing down step by step so we can figure out exactly what the market is reacting to here.
Okay, let's look at our roadmap for making sense of this wall of financial metrics. Part 1, we'll meet Centuri Holdings. Part 2, valuing the stock. Part 3, we look at operating efficiency and debt. And finally, Part 4, a bizarre situation we're calling the growth paradox. Let's jump in. Section 1. Meet Centuri Holdings, the vital signs.
Right off the bat, looking at the baseline vital signs, we've got a mid-cap company valued at just over $3.1 billion, trading at around $31 a share. So right away, you know this isn't some tiny, unknown micro-cap flying under the radar. This is a substantial business with literally billions of dollars on the line.
And just look at their recent market performance. Over the trailing 12 months, they are boasting a massive 56% return. That is some serious momentum. They're also sitting on a solid year-to-date gain of nearly 24%. But, and there's always a but, right? The last week has been a bit painful with a near 10% drop. It's a volatile stock for sure.
Moving on to Section 2, valuing the stock, diagnosing the price. All right, take a look at this number, 92.03. This is the current price to earnings, or PE ratio, for CTRI. Now, if you've been around the market for a minute, you know that an earnings multiple of 92 is, frankly, sky high. It immediately raises some eyebrows. It basically tells us investors are willing to pay $92 for every single dollar of earnings this company generates. Normally, that points to either massive expected growth or a severely depressed current earnings number.
But hey, context is everything, right? What's really interesting here is that this seemingly crazy 92 PE is actually a massive 61% drop from their trailing 12-month average. Over the last year, their average PE was an astronomical 238. So while 92 looks insanely expensive in a vacuum, relative to its own recent history, the valuation is actually cooling off dramatically. If we zoom out and look holistically at enterprise value, which factors in debt and cash against operating profits, we see slight upticks across the board compared to recent averages. Their EV to EBIT is sitting just under 38, EV to sales is a totally reasonable 1.21, and EV to EBITDA is sitting at almost 16, which is up about 10% from its trailing average. So the market is definitely pricing this company at a premium to its operating profits, but it's not totally detached from reality. But wait, because here is where we hit a fascinating contradiction. Look at the PEG ratio. It currently sits at an incredibly low 0.06. That's practically zero. It represents a staggering 97% drop from its trailing 12-month average. Now remember, the PE ratio factors in growth. You take that massive PE ratio we just talked about, and you divide it by the earnings growth rate. So a number this close to absolute zero suggests the market might actually be pricing in some explosive short-term earnings momentum. It's like a giant puzzle. The standard PE ratio screams expensive, but the PE ratio's over here whispering undervalued relative to growth. That is a huge discrepancy.
All right, let's pop the hood. Section 3, operating efficiency and debt, under the hood. The crucial point we need to make here is about balance. Centuri Holdings is actually managing its obligations pretty well. Their debt is actively shrinking, currently sitting at a debt-to-equity ratio of 0.86, which is down almost 35% from its recent average. Plus, their short-term liquidity is quite healthy. With a current and quick ratio of 1.88, they have almost twice as many liquid assets as short-term liabilities. So a sudden liquidity crunch? Not really an immediate danger. But when we get into their profitability margins, things get incredibly tight. This perfectly illustrates the challenge of their business model. They operate on a gross profit margin of just 8.4%. And by the time all the bills are paid, they are left with a razor-thin net profit margin of about 1/3%. Yep, 0.34%. That gives them a very modest return on equity of just 3.57%. Make no mistake, this is a high-revenue, low-margin environment. And because those margins are so razor-thin, we absolutely have to look at their trailing 12-month free cash flow. It's currently sitting deep in the red at negative $55.79 million. Think about that for a second. Despite bringing in over $3 billion in top-line revenue over the last year, the actual cash left over after operations and capital expenditures is negative. That gives them a negative free cash flow yield of 1.77%. Which brings us to Section 4, the growth paradox, boom or bust. No, your eyes are not playing tricks on you. You aren't reading that correctly. Over the trailing 12 months, CTRI has experienced a jaw-dropping net income compound annual growth rate of over 7,700%. Their net income over the last year just spiked to $30.8 million. It's an absolute explosion in short-term profitability compared to their previous numbers. Yet the moment we zoom out beyond that one-year window, the patient completely flatlines. Look at this. Virtually every single 3-year and 5-year growth metric across revenue, net income, earnings per share, and free cash flow sits squarely at 0%. The historical averages show absolutely zero compounding growth over a medium to long-term horizon. It is perfectly stagnant. And you can see this exact same paradox visualized perfectly in their stock price. There's this immense short-term velocity over the last year, with a trailing 12-month price growth of over 77%, but stretch that timeline out to 3 years, it drops to a mediocre 13.7%, stretch it to 5 years, absolutely 0% growth. The short term looks like a rocket ship, but the long term looks like a treadmill. So based on all the raw data we've unpacked in this explainer today, this is the ultimate question you have to ask yourself. Is Centuri Holdings just experiencing a temporary, highly volatile short-term spike that's inevitably going to revert back to its historical flatline? Or does that unbelievable 7,000% surge in recent net income mean we are witnessing the very beginning of a massive long-term breakout? The numbers clearly present the paradox. Now it's up to you to decode the future.